Hello, this is Jim Barlow with OakTree Premium Finance. Our topic today is legacy planning, passing on your wealth to your family. There's really going to be three sections to this webinar. The first is kind of a review of various things about Kaizen and my company. Second, we're going to tackle the topic, legacy planning. And third, we're going to use the Kaizen site to show you some examples of legacy planning and how it could happen for you. Also, my next webinar is October 11th, Wednesday, 10 a.m. Kaizen for Retain and Recruit. This is for employers to retain and recruit their employees and keep them happy. Let's get started. Good summary. We specialize in Kaizen, a unique enhanced investment strategy utilizing life insurance with a significant portion of the premiums being financed, approximately 3-to-1 leveraged or financed. An example, if you put in 100,000, then we have a bank put in 300,000. If compound interest is indeed the eighth wonder of the world, then leveraged compounding is certainly the 9th, 10th, and the 11th. Petros Manos. Here's the key aspects of Kaizen that you need to understand. 1, the money grows tax deferred and eventually can become tax free. Therefore, it eliminates tax risk. 2, performance. Market returns, or sometimes better than market returns, with no downside. Eliminates market risk. 3rd, leverage maximized funding, up to 3-to-1. Reduces the amount of money you have to put into retirement. Without collateral, personal guarantees, loan documents, interest payments, credit checks. 5 annual payments, that's it. You also still have the death benefits, the living benefits, the terminal illness, chronic illness, critical illness. You have a long-term care policy here. These are the key aspects. Here's our services, our products, our uses. 1, we still offer traditional premium finance, where you put up collateral, and we won't get a major explanation today, but the blue are the personal uses for Kaizen. Retirement income, the number one reason we use it a lot. Number 2, transferring wealth, which is our topic today. Infinite banking, build up these assets and then you'll be the bank forever. This is a fixed income alternative and just plain old life insurance and living benefits. It's been shown that it is very efficient and less expensive than a lot of options. The green boxes are the corporate world, the executive employee benefits. That's the topic for our next webinar. And there's other business uses. And we just added a new thing. For those who don't qualify because they're too old for Kaizen, but they basically have the desire to do something like this, we have a 10-pay program which will give a state expansion and give you long-term care. Here's my chart on ages. So you can see off the top, the general age is 18 to 65. You can't buy Kaizen if you're over 65. 66 and over they won't sell it to you. The blue box on the left are personal uses. We've talked of them just now. The light green box is the corporate employee of the corporate world. And then here's our transferring wealth today that we're talking about. We'll go over this more fully, but the giver, if they're younger than 55, must own Kaizen themselves. And the last one on there is a retirement income. That yellow box is something I added. I think the sweet spot for a retirement income is 55 and below. As you get over this amount age, then it's going to become a little less sweet, not quite as good. You can still purchase it and it'll work, and maybe you'll be purchasing it for one of the other reasons. The qualifications for Kaizen. We've already gone over this one. Between 18 to 65, standard health or better, an annual income of 200,000 or more in most cases, possess the financial resources to make 5 annual payments ranging from 16,000 for a very young person to 44,000 for an older person. And last, you need to give it some time. At least 15 years for your investment to grow before beginning withdrawals. Here's our client knowledge process. We get clients from our clients, and we get clients from Center of Influences, our newsletters we're starting to do, our webinars that we're starting, the social media we do. I believe we have a very good, robust website that gives a lot of information. But the gateway, as I call it, is our QR code. See it down there on the lower right side? You could share this QR code with a friend and say, hey, see what you think of this product. The QR code has a video on it and an explanation on what Kaizen is. If they have an interest, there'll be a place to put their name and phone number, email on there, and I'll get an email back saying they have an interest. I'll give them a phone call and do this exploratory conversation. What are your needs? What are your wants? What you're trying to achieve? Another question I'll be asking, how do you like to gain knowledge? We have this site called My Ilia that you have to have a login and a password to get into it. But once in, it is extremely robust about Kaizen. If you're a Amazon type learner that you just want to sit and read on your own, go over it, this should answer 98% of your questions. And you're on your own, just having fun. We're going to go to that site at the end of our webinar today and show you how robust it is. But if you're a different learner, I love to go to lunch. I'll take you to lunch. You can come back for more webinars. I've got a list of webinars I want to do on different topics. Even my website, I think is getting there to the way I'm really proud of it. The enrollment is all online on this My Ilia website, and it's pretty smooth. Even the least savvy computer person can do it. Here is my client and center of influence participation levels. If you give a friend the QR code and they inquire through the QR code, I want to know more information, I'll give you an $100 Amazon gift card. If you like this a lot, you might want to get life insurance licensed. It costs about $500. Then you give that QR code to your friends, and in addition, I'll give you 10% of the sale, or about $4,000 a typical sale. So $400. Some of you might like it even so far that you want to start doing it full time. I'll help you and help you learn how to present it and all the ins and outs. And I'm really looking for people that want to come and join me full time and put together a company of like-minded individuals. Well, that's the preliminary information. Let's get into legacy planning, passing your wealth to your family. And this is a slide to tell me to go to the video. This is my website, and I've got a section here on the website called videos. And these are the top 6, I think, at this very time. I've got an archive of 5 other videos, but and I'm looking at even adding others, but this is the video section, and the one I want to watch today is the greatest wealth transfer.
After meeting with your financial advisor, you're happy to learn that all your hard work and sacrifice have put you in a place of wealth, allowing you to live the retirement of your dreams with those you love the most. The only thing left to think about is, what will I pass down to my children or grandchildren? Wealth transfers done through annual gift tax exemptions or lifetime gifting exclusions often raise a question. What will our kids do with all our hard-earned money? Much like winning the lottery, access to inheritance all at once can be spent in the blink of an eye. In the US, 80% of people have trouble keeping their spending within their budget's parameters. Would you rather give your kids $250,000 in cash now, or give them the potential for 5 to 10 times that in their retirement? Introducing the greatest wealth transfer, brought to you by Kaizen. Kaizen is a way to provide annual gifts to your children to fund a uniquely designed life insurance policy. Why life insurance? Because life insurance can provide your loved ones with death benefit protection that passes tax-free to their beneficiaries. Life insurance also provides the potential to earn interest. Any potential gains are locked in annually and compounding tax-deferred. Because your money is not directly invested in the market, it cannot suffer losses due to market declines, making it one of the safest products to combine with leverage. Why use leverage? Because Kaizen can enhance your policy benefits and potential distributions by an average of 60 to 100%, which can be taken tax-free when using policy loans. Using leverage means you don't have to fund for years like most policies. With Kaizen, there are only 5 annual contributions, of which a small portion is used to fund death benefit and living benefits. The remainder of your contributions are combined with leverage, enhancing your potential for growth. In approximately the 15th year, the loan is paid off with the policy cash value. This means your heirs won't have to wait until retirement age to access the policy. They may use it to fund a first-time home, college education for a grandchild, or help supplement their retirement. Kaizen uses unique life insurance for a reason: safety. Just like a butterfly, your wealth undergoes remarkable transformations. Think of your current wealth as a caterpillar stage, steadily accumulating over the years. By implementing a sophisticated strategy, you create the protective shell that fosters growth, similar to the caterpillar's transformation into its cocoon. With our strategy, your wealth isn't static. It has the potential to expand, much like the caterpillar turning into a butterfly. As you pass on this augmented wealth to your children, you create a financial legacy that shapes their future. Take comfort in knowing your gift can provide your loved ones benefits for a lifetime. Don't leave your legacy to chance. Leave it to the greatest wealth transfer by Kaizen.
All right. I think that is an excellent video. I like the explanation. They do a great job. And I really love the analogy of the butterfly, the caterpillar going into a cocoon. That is life. We have to be patient with any of our investments, certainly with Kaizen. So let's get into the nitty gritty. Let's start with the gift tax annual exclusion. The gift tax is a tax imposed on the transfer of assets from one individual to another during their lifetime. However, there are certain exclusions and exemptions in place to prevent taxing smaller routine gifts. The gift tax annual exclusion is the maximum amount of money or property that an individual can give to another person without triggering any gift tax liability. Currently, 2023, the gift tax annual exclusion is $17,000 per recipient per year. This means an individual can give up to $17,000 to any number of recipients in a calendar year without needing to report the gift to the IRS or worrying about a gift tax. Married couples can split their gift, effectively allowing them to give up to $34,000 per recipient per year without incurring the gift tax. Now, in reality, when you file this gift tax form, you really don't pay a tax. You just claim part of your estate tax available. You're using some of your estate tax early, but you do have to file the form if you're over the 17 and 34,000. Nice and not to file the form. So here's the estate tax rules. The estate tax is a tax imposed on the transfer of a person's wealth upon their death. It's applicable to the value of individual estate that exceeds a certain threshold. The estate tax rules include both a basic exclusion and a mountain top tax rate. As of 2023, the basic exclusion amount for estate tax was $12,920,000, meaning estates valued below this threshold were not subject to estate tax. The current exclusion amounts was created by the Tax Cuts and Jobs Act of 2017, which increased gift and estate tax exclusion amounts beginning in 2018 through 2025. However, on January 1st, 2026, the exclusion amount will sunset and revert back to the 2017 amount of $5 million adjusted for inflation. So what's going to happen in 2025 before January 1st of 2026? We really don't know. There most likely will do something. Here is a little bit of, I think this is interesting. I did this chart going back to the first year I was in the investment world helping clients was 1983. So estate taxes from 83 to 2001 was $3 million. And the excess tax was 55%. So the techniques back then was to put, if let's say your estate was 6 million, to put 3 million in two trusts, one in your wife's name or your spouse's name. I'm sorry, should use this properly. Spouse's name and 3 in yours. So you get a claim 6 million. If you didn't do that and kept everything jointly, then you'd pay taxes anything over 3 million. Had a client back about 1984. This lady was in her mid 60s, had a $7 million sheep ranch. Ran sheep. Her husband had passed away a few years before, and she didn't have a lot of assets, but she had a $7 million ranch. And I was explaining to her that the 4 million over the 3 that should have to pay a estate tax on of 55%, which is roughly 2 million. And she thought I was lying. This could not happen. And if you take this story a step further, at her demise, her estate would need to sell the ranch, and it'd be sold at a fire sale price, not 7, maybe 5. Then you'd pay the 2 in estate tax, and you'd be left with 3. 7 to 3. Wow. There are techniques and I had a suggestion of how to avoid the estate tax, but I'm not going to make a big pitch on that today. But anyway, if you look at this chart, you can see that it went down to 2.5 million in 2002, then to 2 million, 2003 to 2008, not that long ago. Then it started creeping up 3.5, 5, and then it started having an adjustment for inflation. And then we have 2017 when they passed that new law. And so it went to 11,180,000, and this is adjusted for inflation. So here we are in 2023. Where it'll go in a couple of years, we don't know. But that's the estate tax. Just want to make sure my screens are all working. I think they are. Okay. I'm new at these webinar things. All right. So here's my first question. Why the wealthy may choose not to gift? This is, I think this is a sensible approach. May need the assets. Well, we almost all think we need the assets. Interesting. There's 2.52 trillion invested in annuities. 84% purchased them for their retirement income. The average age of an annuity owner is 70, and they're not tax-free. Annuities, you have to pay taxes eventually, but money is being set aside for their retirement. And a lot of people are content to have their assets transferred at their death. And if that's the case, I really strongly recommend looking at trusts, which we'll be talking about. There also fear that funds won't be spent judiciously if they give it away. They want their gift, if we're going to give it away today, to be meaningful. So after you leave money to your children, how fast do you think they're going to spend it? It's not known to be good. I'm sure you were thinking that they'll be judicious and do a good job. The majority is spent in less than a year. Many beneficiaries view their inheritance as free money. Experts say some run through their sudden wealth on cars, major houses, renovation, gifts to children. They oftentimes don't know they pay a tax on the IRAs and 401ks. When someone gets an inheritance, there's a feeling of invincibility. Look at the money I've got. When people feel invincible, they usually don't make good decisions. And there's lots of issues. There's family relations, there's unpreparedness, there's expectations and pressures, loss of motivation. A lot of things can affect why they spend their money the way they do. Few stories from my career. During my time as an advisor at a bank-owned advisory firm, I had a conversation with a young woman in her 30s who had inherited $90,000, which is about 180 in today's dollars. We crafted a plan that she was genuinely enthusiastic about, but she wanted to initiate it after addressing a few matters. I'm a bit ashamed to admit that back then the protective laws, the privacy laws, weren't as robust as they are now. I used to review her bank account periodically, and I'm sure you can guess the outcome. I witnessed her funds gradually diminish to nothing. No plan took place. Here's another interesting story. I assisted a young woman around 40 years old who had unfortunately lost her husband. She received a life insurance payout of $500,000, about $1 million today. We decided to invest half of it in mutual funds, the other half in annuities. However, I wonder if I did a good job, or maybe I didn't explain things well, because she started withdrawing the money shortly afterwards, and within 2 years, she had completely depleted her funds. I kind of talked to her about it over the 2 years, but by the end of the ordeal, I was very frustrated and blurted out, "What happened? Why did you do this? Where did all the money go?" Surprisingly, her response was, "I'm actually relieved that it's all gone. Now my relatives will stop asking me for money." There's a lot of unusual reasons why money is spent. Here's another example. Squandered wealth stems from an acquaintance of mine. Following a tragic passing of his wife in a car accident, family received a settlement totaling about $1,700,000, about $4 million in today's dollars. Furthermore, his father had established a trust fund that provided him with approximately a monthly sum of $5,000 over a 25-year period. He relocated from his former residence to be closer to his relatives, purchased a house that he continually renovated, and eventually lost it. He indulged in luxury goods, vacation packages for his kids, new vehicles for his kids. He even acquired a business and unfortunately mismanaged it, resulting in its eventual failure. Currently, he resides in a trailer home, relying solely upon his and his current wife's Social Security for their income. Lost it all. So let's just review your options. Immediate family support, financial support. This involves offering monetary assistance promptly, addressing the myriad financial demands associated with raising a family. You know it, you understand it. We recently embarked on this route. We chose not to use Kaizen in this example. After selecting the designated amount, we decided to provide a financial help to our family. The gesture caught them off guard, sparked both surprise and gratitude. I'm relieved that their appreciation was genuine, and it's heartening to observe that the funds were used judiciously. Could they have been used poorly? Sure. I'm glad they weren't. Won't be always the case, but we did this at that time. At your death. Obviously, you know about wills, but I'm a fan of trust. Let me explain a little bit. Another avenue for consideration involves establishing a trust, a legal entity empowered to manage and oversee assets. Constructing your own trust usually entails designating yourself as a primary trustee and selecting subsequent trustees. I've had the honor of serving as trustee on 2 occasions after the demise of the individual. Once was for my mother and once for my brother-in-law. Serious occasions, solemn occasions, but they went very, very smoothly and there was no problems involved. My estate planning attorney is Chris Finley. Commendable job. I recommend them to anyone who wants to look into a trust. Is there a way to give something today that I can control a little bit more than an outright gift? Or a way to give them future security, life insurance, long-term care, disability insurance, a retirement income? Well, you already know the answer is Kaizen. These are those key aspects of Kaizen that we already reviewed. Let me just go back. I reorganized those points in a different order, as if I'm thinking about the transfer of wealth. And what would be the bullet points of transferring wealth? Well, here's the order. I utilize leverage to enhance the gift 5 to 10 times more. Only 5 annual contributions. I could handle that. Provides death benefits and living benefits. I like that for my kids. Tax-free distributions through policy loans. Tax-free, wow. Tax-deferred growth without downside market risk. Sounds good. And the policy is collateralized, assigned for 15 years. Limited access. It was talked a little bit about in the video. This sounds like a pretty good approach. Qualifications. The giver must have an income of 200,000 or more and a net worth of 3 million. The giver must have adequate death benefit on themselves. If they're under 55, they must own Kaizen on themselves. They don't have to if they're over 55. And the person receiving the gift must be 18. You knew that one. The video had this great quote. Think of your current wealth as a caterpillar stage, steadily accumulating over years. By implementing a sophisticated strategy, you create the protective shell that fosters growth. Similar to the caterpillar's transformation into a cocoon, with our strategy with Kaizen, your wealth isn't static. It has the potential to expand, much like the caterpillar turning into a butterfly. At this point, this slide is to remind me to go to the ILIA site and show you some comparisons. Okay, this is the site. On the left-hand side, we have an index. And it has a lot of information. It has plan details at the bottom. You can scroll through and read all that. You got minimizing risk information. You've got information on the leverage, the product itself, a lot of the things you saw in the video. There's even a couple of videos. Here's a video on how it works. Financial solutions, what your issues are, and some options. And there's an introductory video right at the front. But the section I want to go to is estimate my benefits. In this section, we have two areas at the top. Let me change my pointer. We use the spotlight. Oh, it didn't go. There we go. So we have quick results estimator, and then we have a custom design. We're going to go to the quick results first and show you how easy this is. So, oh, I didn't know I can't. This is just a pointer. I didn't know that. Guess I better get on the ball. So we can put in the age. and male and female. And remember, the youngest age is 18, so we'll stay with 18. And the least expensive are female, so I'm going to go female. And then down here, we have a slide scale, and it's set at 40, but you can put how much you want to put in per year. You can adjust this, and I'm going to try to adjust it to the very bottom. All right, it's showing 20,000. I think if we go to the custom design, it'd be, oh, it actually shows here 15.7, but we've got it. I couldn't change it anymore, so let's leave it at 20,000. So let's click calculate. And here the video showed the 5 payments, and it shows the bank payments in the green. And then it shows here the 5 additional payments the bank continues to pay, and the bank pays your payments. So here's the numbers. So you put in 100,000 and they put in 233,000. Not quite 3 to 1. So we've got $333,080 put in. And I want to show you this number down here. It shows 6.71. This is the growth rate that we're going to illustrate at. And the historical growth rate, Kaizen is a little over 10 years. We've averaged a little over 8.5% per year on all policies. So this is lower, and that's good. We don't want to estimate a return that is not achieved. So you will be happily surprised as the performance is better. Another number not shown here is the interest rate you're paying. And they're using a 1% lower than the 6.71. So they're using 5.71. We call that 1% the spread. And obviously you want a spread if you in your home mortgage, if you're paying 5, you want to have it growing at 10 or 15, you want a spread. The spread on bank loans and insurance company loans since 1930, almost 100 years, has never been, over a 15-year period of time, never been less than 2. So we're going to use 1. So we're using a spread that has never been this low. And with that in mind, the numbers should all be better than the ones I'm going to show you. But let's go to the numbers. So I'm going to click this benefits and distributions. And here's all our numbers. First, we're buying a life insurance policy on this 18-year-old of $1,162,348. And because the rate the money's making and the spread and the interest you're paying, internal rate of return is bumped up to 8.27, and this is conservative numbers. And at age 65, this 18-year-old is in a position to get $245,000 per year tax-free per year. And by the time they hit 90, they would have pulled out $6,370,000 tax-free, and then still have a death benefit of $2,284,541. At this point, some people say this looks a little bit too good to be true, but because of the tax-free, the no downside, market returns and better, and we're even be conservative with our numbers, and the leverage is phenomenal. Now, next I want to show you comparisons. So here's that 245 a year, 6 million total. If we did it in the same policy, but without the leverage, the Kaizen, our income would be 145,000, 100,000 less. Our total would have been 3,770,000. If we did it in a regular investment account, same return, same criteria, your income would be 79,259 and a total of 2 million. And if you did it in an IRA 401k, your income would be 105,000. Kaizen has a lot of pluses to it. If you qualify, it's really super. Now, we want to wrap this up, but I do want to go to the custom design and show you the little differences here. So first, I'm going to do a new custom design. And we put a lot more information here. We put a name in, and I'm going to put the name of A, B. And we got to select a birth date, and I'm going to put 0101 2000. That's a 23-year-old. Why don't we put 1995? Now we got a 28-year-old. So we didn't go with the 20-year-old, an 18-year-old. We went 10 years later. So we have 10 less years, but we're going to select we'll do male this time. And we select a health, average health or excellent. They ask us the question, does the client use tobacco or marijuana products? I'll put no. Then we're going to push next. Then they ask us the question, do you want maximum death benefit or do you want a maximum income and retirement? This is in the custom, you can do this custom adjustment. I'm still going to go with income. And then because of the age, it's going to show you the minimum. And the minimum for this 28-year-old was 21,350. I'm going to put 22, make it a round number. And then I'm going to push next. And here we get to make another decision. When do we want income to start? In the previous one, we just automatically, it was 65 and the income ending at 90. But you could set it up earlier year, you can set up later, whatever you want. I'll just stay with this one. But now at this point, this is doing a lot more calculation because we're going to have an illustration. The insurance company has to stand behind and everything. So they're saying they're doing a stress test. So while they're doing this stress test, I can go down, scroll down. Oops, I'm sorry, I can't scroll down. I forgot it. On this stress test, they've stress tested Kaizen with the 1980s, the high interest rate environment, and Kaizen turned out great. It handled a terrible high interest rate market. They also stress tested it with the 1930s when the stock market was horrendously bad, and it came out okay then too. So even in the two opposite scenarios of problems, Kaizen works. Now, it did this calculation. Notice up here at the top is loading the illustration, but we do have all the numbers crunched here. So here's the 110,000 we're putting in. The bank's putting in 284. We're using that same 6.71. We can click benefits and see how much life insurance. 913,000 internal rate, income of 135,000 starting at age 65, total of 3,510,000. You can do the comparison. 135 to 79 to 48 to 63. And so you've got all this report, but here on the custom, I can view the illustration. Let's see. Let me click that again. Well, you don't want to have this is what I was looking for. It didn't pop up right. I was afraid we had a computer glitch. Anyway, on the client proposal, and there's the name AB, and we've got all the details. Explanation, full explanation on the contribution, the performance, and at the very end, it has a spreadsheet showing you all the numbers, very robust and thorough. Now, if we click the carrier illustration, this is, I didn't know I did Allianz. We can do National Life or Allianz. Allianz is brand new, but you can see you've got all the details here, even more thorough. But this is the legal binding from the company, the illustration that's given to you. Anyway, with an invitation to this website, you can put your own numbers in, how much you want to contribute. Do you want to do it on Billy, who's 40? You can do it on yourself. You can just play around with the performance numbers, and you can read all this information and come to the conclusions you want. Again, I'm ready to help people understand things. I hope you enjoyed the webinar. We've covered the basics. We've covered transferring wealth to your kids. And then we showed some examples in this my ILIA site. And we'll have other webinars on other topics. And with that, let's call it a day and we'll end the webinar.